And finally, Tom, if we tie it all together with that JOLTS number, let's take a look at the chart here, because you can see that coming out of 2020, a massive rise higher, and now we're dipping lower, but that number up just a little bit more. I would say that overall, we probably will see these numbers start to come back in toward the 2020 levels. But again, the number a little bit blowout, like Alex was talking about, putting pressure on the markets.
Yeah, we're going to stay on that story, get more analysis now. Abigail Doolittle, thank you for the market check and the reaction to those hotter than expected numbers in terms of the JOLTS data and in terms of those job openings. Let's bring in Rubeela Farooqi now, high frequency economics chief US economist. Just to start there then, Rubeela, your reaction to these numbers.
Thanks for having me on the show. Yeah, I mean, the data that we're seeing on the labor market in particular and inflation, it's just showing that we're not moving in the right direction. The Fed has done a lot, and they expect a rebalancing in conditions, and we're just not seeing that. If you look at the jobless claims numbers, if you look at job openings, and if you look at the pace of, the pace at which the economy is creating jobs, it's just not, we're just not seeing the effects of 500 basis points of tightening yet. In terms of how the Fed is going to view this, obviously the acceleration in the PCE deflated their favored inflation gauge, combined with what we're seeing in the labor market. If we see another blockbuster report in terms of the employment report on Friday, it just makes the Fed's job that much harder. In terms of how much further will they go, and what will be the effects on the economy.
Rubeela, the quits rate, though, did fall to more than a 2-year low. Silver lining? How do you read that?
It did, but if you also look at layoffs, they also declined, right? So, I mean, there is a slight adjustment in the labor market in terms of we have come off the peaks, but we're very far from where we need to be, no matter what metric you look at. So I do think that this just is showing that the response on inflation, the response in the labor market, it has been very gradual and very slow, and it just raises the odds that maybe, the Fed has more to do, to slow and rebalance the labor market and to lower inflation.
Rubeela, is this just a reminder that maybe the Fed needs to start thinking that this is a labour market with such strength, such resilience, that the trends have changed post-COVID, whether it's around the energy transition, whether it's around household balance sheets, that means that this is a labour market in the US that's just not as sensitive to rate rises as historically it has been?
Right. And if you look at what we are looking at in terms of inflation, that super core figure, that is not, especially responsive to rate increases. So that is where we're seeing the demand. But, this is the Fed's only tool, and this is the only way that they can, try to slow economic activity. We do think that this economy is not completely immune to rate hikes, and we do expect to see a response. It's just that the dynamics in the labor market have shifted so substantially since the pandemic, in terms of the supply side issues that are continuing. It's just that, rebalancing that demand and supply has been a substantial challenge.
And Tom, we could have gotten some help here, maybe from the debt ceiling deal, but from what the CBO is scoring, it doesn't necessarily look like it's going to be enough subtracted from GDP to really hit employment, or not. I don't know. We have spending cuts over the next 2 years. Will that help to do the Fed's job for it?
I mean, you touched on the fact it's slightly perverse, isn't it, to be talking about the need to see more people out of work, to be in a place where we're slightly more comfortable, and you rightly kind of nodded to that. But again, the dynamics here, and it's not unique to the US, of course, here in the UK, and I know you have this theme around the UK sucking, but the UK also has a very tight labour market, despite it sucking to the extent that it does. So this is a challenge not unique to the US. Rubeela, is June baked in then for the Fed? Do we need to start thinking about 6%? From this Federal Reserve?
That's a very difficult question to answer. Like I said, if we have another inflation report coming out, we have another employment report on Friday. The data right now are not moving in the right direction. So I would say, yes, the FOMC could easily lean towards another 25 basis point rate hike in June. That is not our base case. We still think that there is further tightening in credit conditions that's in the pipeline. There's still the effects of 500 basis points of tightening, which means that the Fed can actually take a step back. But I think managing that message in terms of what the market expectations are and what Fed officials might actually do, that's going to be difficult. But I do think that the odds increase if we do see another solid gain in payrolls, average hourly earnings not really moving very much, and the CPI data, we don't really expect to see much of an improvement in the core index, and that is what we're really focusing on. But I do think there is room here for them to take a breath, but the data is certainly not moving in the right direction right now.
Okay, to be fair, I don't think that the UK sucks. To be fair, what happens is every time Tom's on the show, there's like really negative UK data that comes out, and I do have in my notes today, UK sucks. Business confidence falling. So this is real stuff. Last question, Rubeela. Markets pricing out cuts. Will that kind of help rather than having to hike again?
At the end of the day, the data on inflation and the labor market are going to drive the rate decisions, right? I mean, this is not about that the market should price out cuts. The pricing in cuts in the first place was very contrary to what the Fed was saying. So that has never been our base case. We actually don't even expect a recession this year. Mm-hmm. But, it's just a matter of where the inflation data go and where that labor market is heading. And like I said, not heading in the right direction. So I think that's going to drive their decisions at the end of the day. But, rate cuts getting priced out, I think that is the correct market response.